What if I told you that one of India's best performing consumer companies has quietly made a strategic move that could reshape its business over the next decade? Varun Beverages Limited, popularly known as VBL, has built one of the strongest beverage distribution networks in the country through its long standing partnership with PepsiCo. But now, the company is preparing for something much bigger. It is entering completely new product categories through a strategic tie up with Japan's Asahi Group. Is this just another product launch? Or is it the beginning of VBL's transformation from a soft drink bottler into a diversified food and beverage company? Could this become the next long term growth trigger for the company? Should long term investors pay close attention? In today's video, based on the Business Standard article dated 27th of June 2026, we will analyze the strategic partnership between Varun Beverages and Japan's Asahi Group. We will understand why this agreement is important, how it changes VBL's future growth strategy, what leading brokerages are saying, what opportunities and risks investors should watch, and whether this development could improve the company's long-term valuation. Stay with me until the end because this is not just another business expansion story. It could mark the beginning of the next phase of growth for one of India's fastest growing consumer companies. About Varun Beverages. Before understanding the importance of this development, let us first understand the company. Varun Beverages Limited is one of PepsiCo's largest franchise bottlers in the world. The company manufactures, bottles, distributes, and sells PepsiCo beverages across India and several international markets. Its product portfolio includes carbonated soft drinks, packaged drinking water, juices, sports drinks, and other ready to drink beverages. Over the last several years, VBL has consistently delivered strong revenue growth, expanded its manufacturing capacity, entered new international markets, and strengthened its distribution network. As a result, the company has become one of the best performing FMCG related companies in the Indian stock market. However, one important question has always remained. Can VBL reduce its dependence on carbonated beverages and build new long-term growth engines? According to the Business Standard article, the new partnership with Asahi may provide an important answer. What is the new partnership? According to the Business Standard article dated the 27th of June 2026, Varun Beverages has entered into a strategic partnership with Japan's Asahi Group after PepsiCo revised its long-term agreement with the company. The revised agreement extends VBL's relationship with PepsiCo until the year 2049. More importantly, it removes earlier restrictions that prevented VBL from undertaking non-Pepsi beverage businesses. This gives the company significant flexibility to diversify into adjacent food and beverage categories. The first products expected under this partnership are ready-to-drink, non-alcoholic, non-carbonated dairy-based beverages under the Calpis brand. Under the arrangement, Asahi will provide product development expertise and technical support, while Varun Beverages will manufacture, market, distribute, and sell these products through its existing manufacturing facilities and extensive distribution network. Although the financial contribution from these products may initially be small, analysts believe this partnership creates a platform for several future product launches and business expansion opportunities. Why is this deal strategically important? This partnership is much more important than a simple product launch. First, it reduces the company's dependence on a single product category. Second, it allows VBL to utilize its existing manufacturing plants and nationwide distribution network more efficiently. Third, the partnership enables entry into faster-growing beverage categories where consumer preferences are gradually shifting towards healthier, functional, and dairy-based drinks. Fourth, it increases the company's long-term strategic flexibility. Instead of depending only on carbonated beverages, VBL now has an opportunity to become a diversified food and beverage company. In simple words, the company is not just increasing sales volumes, it is expanding the size of the market in which it can operate. That is why many analysts consider this development a long-term strategic milestone rather than just another product launch. What are brokerages seeing? The Business Standard article highlights positive views from several leading brokerage firms. Axis Capital believes the Asahi partnership strengthens VBL's diversification strategy and continues to maintain an ad rating with a target price of approximately 585 rupees. Kotak Institutional Equities believes the agreement could become a long-term re-rating trigger by gradually transforming VBL from primarily a beverage bottler into a broader food and beverage company. Citi Research also remains positive on the company's outlook because of continued volume growth, improving operating leverage, and strong seasonal demand. While brokerage target prices should never be treated as guarantees, it is noteworthy that several research firms view this partnership as an important long-term growth catalyst. Financial performance supporting future growth. The partnership comes at a time when the company is already performing strongly. According to the article, VBL reported healthy fourth quarter financial performance supported by strong volume growth in its India beverages business. Operating profit improved because of better product realizations and continued expansion in international markets. The company is also expected to benefit from acquisitions such as Twiza and Crickley. This means the Asahi partnership is not intended to solve a weak business problem. Instead, it is designed to build an additional layer of future growth on an already strong operating business. Opportunities for the company. The partnership creates several long-term opportunities. The company can expand into higher growth beverage categories. It can improve utilization of its existing manufacturing facilities. It can leverage one of India's strongest beverage distribution networks. It can reduce dependence on carbonated beverages. It can improve its long-term revenue mix. It can create multiple future growth engines. If the strategy is executed successfully, VBL may gradually evolve into a much broader food and beverage company rather than remaining only a Pepsi bottling business. Risks investors should monitor. Although the long-term opportunity appears attractive, investors should also understand the associated risks. The initial contribution from the new product categories may remain relatively small. Consumer acceptance of dairy-based beverages cannot be guaranteed. Competition in the health beverage and dairy beverage segments is intense. Successful execution across manufacturing, branding, marketing, and distribution will be critical. Commodity prices, raw material inflation, and foreign exchange movements may also influence profitability. As with every business expansion, successful execution will determine whether this strategic initiative ultimately creates long-term shareholder value. Investor takeaway. The Asahi partnership should not be viewed simply as a product launch. It represents a strategic transformation in the company's long-term business model. Varun Beverages is attempting to diversify its revenue base, reduce dependence on traditional carbonated beverages, and build new growth platforms for the future. If the company executes this strategy effectively, it could strengthen its competitive position and improve long-term earnings growth. However, investors should continue monitoring quarterly financial results, product launches, market acceptance, operating margins, and future management commentary before drawing long-term conclusions. Final conclusion: the Business Standard article dated the 27th of June 2026 highlights a significant strategic development for Varun Beverages. The revised PepsiCo agreement and the partnership with Japan's Asahi Group provide the company with greater flexibility to enter new product categories while leveraging its existing manufacturing capacity and distribution network. Although the financial contribution from the partnership may initially be modest, the long-term strategic significance is substantial. For investors, the important question is no longer whether Varun Beverages can continue growing its existing business. The more important question is whether the company can successfully transform itself into a diversified food and beverage company over the next decade. That will be one of the key stories for investors to watch in the years ahead. If you found this analysis useful, subscribe to Suffer or Seek Knowledge for detailed company analysis, business strategy, stock market insights, IPO reviews, corporate developments, and practical investment education. #Disclaimer. This analysis is based on the Business Standard article dated the 27th of June 2026 and other publicly available information. It is intended solely for educational and informational purposes and should not be construed as investment, financial, legal, or tax advice. Brokerage opinions and target prices discussed in this video belong to the respective research firms and should not be considered recommendations by this channel. Investors should conduct their own research and consult a qualified financial advisor before making any investment decision. Disclaimer: the content published on Suffer or Seek Knowledge is intended solely for educational, informational, and knowledge sharing purposes. The views, opinions, analysis, and discussions presented on this channel are based on publicly available information, official disclosures, applicable laws, regulations, financial statements, annual reports, stock exchange filings, and other reliable sources believed to be accurate at the time of publication. The information shared on this channel does not constitute legal, financial, investment, tax, accounting, or professional advice, nor should it be treated as a recommendation to buy, sell, or hold any security, financial instrument, or investment product. Company analysis, business news, stock market discussions, IPO reviews, regulatory updates, and corporate governance topics represent the creator's educational interpretation of publicly available information. Viewers should independently verify facts and consult qualified legal, financial, tax, or investment professionals before making any business, legal, or investment decisions. Investments in securities and financial markets are subject to market risks. Past performance does not guarantee future results. The creator and Suffer or Seek Knowledge shall not be responsible for any direct or indirect loss or damage arising from reliance on the information presented on this channel. This channel is independent and is not affiliated with, endorsed by, or representing any company, stock exchange, regulatory authority, government body, listed entity, financial institution, or professional organization, including but not limited to SEBI, MCA, RBI, BSE, NSE, or any other regulator. All trademarks, company names, logos, and brand names mentioned or displayed belong to their respective owners and are used only for identification, commentary, reporting, criticism, review, or educational purposes where applicable. By viewing this channel, you acknowledge and agree that the content is intended for educational purposes only and that you are solely responsible for your own decisions and actions.